Welcome back to Financial Fit with the
Triple D's. Today we are going to talk about the financial analysis of the companies in the previous video, which are Lululemon, Nike, and Under Armour. So first we're going to talk about the liquidity ratios for our companies. Liquidity ratio pretty much just measures how easily a company can pay off short-term bills using its current assets. So we're going to dive in deeper to two different types of liquidity ratios, which are current ratio and quick ratio. So starting off here with Under Armour, it stays somewhat consistent. You know, it doesn't really have too many highs. It jumps. It stays from about that 2.4 to 1.9 range. So I mean, there's not a lot of huge spikes. It starts up going on an upward trend, and it slowly decreases, but it's not a huge drastic jump where it should like affect the company or anything like that.
So with Nike, it's pretty much the exact same thing. We had a slight decrease from 2024 to 2025, but it shouldn't be much of a problem. I think that's kind of the same with all of our companies.
Same thing with Lulu here. I mean, Lulu, it started off with a 1.8 ratio. It ended up with a 2.1, stayed in between that range. As you can see, the slope is upward and then decreases a little bit, but that's no big issue.
Also, just note all three of the companies are all right at the end.
Yeah.
They're all very similar and very close towards the end.
I agree.
But
we can move on.
Yeah, another thing though about the current ratio is you can see how they're all above the 1.5. So this means that all their total assets are exceeding their total liabilities or current liabilities. Sorry.
Yep.
So they are all doing good in that aspect.
That's good.
Okay, so quick ratio now. We'll jump to that. If someone wants to start.
Yeah, I guess I'll start with Lulu. So Lulu has a quick ratio of anywhere from, so it starts with 1.1, 1.17 to 1.67. The most recent one is sitting at 1.38 of quick ratio.
I'll take over with Nike. They're consistently over the 1.5, which means, I mean, they're overly dependent on selling inventory, which is obviously a good thing. I think we're all kind of in the same area at the end of the year.
Yeah, also Nike does see it surprisingly, it has like a low, it gradually goes down towards the end compared to Lululemon and Under Armour, where we kind of jump.
It's a little more volatile, as you can see.
That's current and quick ratio as well.
Yeah, it is. So like for quick ratio, for instance, if you're one, which none of us are in this situation, which is good, it means having liquidity risk. All of us are about that 1.1 to 1.5, so that means we're considered healthy. 2 is, which none of us really got to. Nike was obviously very close towards the start in 2022 before they started to get decent. That means they're very strong being at 2, but they also could be inefficient with some of their work because they may not be using all their resources to the best of their abilities.
100% agreed.
Okay, so now we're going to jump into a different type of ratio. It's the asset management ratio. So these ratios measure how efficient a company uses its assets to generate sales or manage operations. So the first thing we'll jump to is inventory turnover. So
I'll start with this one as well. So for the inventory turnover ratio, Lulu had started 2022 at 2.7. It ended at 2025 with 2.9. It did have a spike of 3, a ratio of 3 on 2024. But besides that, it's been very constant. The most constant out of the 3, if you could see.
Yeah. I'm gonna jump in then now. Nike's kind of steady as well. I mean, we had a constant growth from 2022 to 2024, starting at 3, and then I think we're at 2024 we're at 3.8. So I mean, it shows that we're pretty good with our inventory turnover.
Yeah. So now with Under Armour, they start just below 3, and then they slowly go down, then they jump right to about that 3% or 3 ratio mark, and then it just slowly increases. But for inventory over 3 to 5 is usually like healthy, so all of us are right around that mark of being healthy. But 2.5 to 3, which you can see Under Armour is mainly in, as well as Lululemon in the years 2023 and 2025. They're still doing good, but they still have some room to improve as well.
I see that Lulu just took over Under Armour, just finally passed.
Yeah, it did, surprisingly.
Are we ready to move to day sales?
Yeah.
All right, perfect. So I could start off for day sales inventory. Day sales and inventory, my bad. So for Lulu, from anywhere from 120 days to 146. The highest The highest days they had in day sales inventory was in 2023, reporting 146 days. So it's honestly really good for athletic wear companies.
Yes. Yeah.
So Nike's DSI ranges from 95 to 122. We saw a slight increase from 2024 to 2025, which isn't a bad thing, but might be worth keeping an eye on.
Yeah, I think Nike's just one of the bigger sports companies out there, if not probably the biggest compared to, the ones I know of. But yeah, I think Nike overall will be fine in that situation, in my opinion. But Under Armour, so we range from about 104 to about 133. Nothing really drastic. We did have a little bit of a spike there in 2024, but nothing. Once again, kind of like Nike, nothing too major. I think Under Armour
you went right back down afterwards, so
Yeah.
I think it's nothing to worry about.
And just like Daniel said in the beginning, these are very good for athletic companies.
Yeah.
Nike is of course the biggest. Lululemon on the rise. Under Armour still kind of hit or miss at the moment, but these are still really good for our companies here.
Yeah.
So now we'll just go in the total debt ratio.
Do we do day sales?
Or no, sorry,
receivables?
day sales receivables.
Sure.
So in day sales receivables, we are going to get. I'll start. Under Armour is, as you can see, it's just kind of at the bottom here. It's very very low compared to the rest. Lululemon Under Armour is at the top. Under Armour is at the top with Lululemon at the bottom.
Yes.
Lululemon's doing very good. Under Armour's at the top. Nike's just hit or miss right in the middle. You kind of got a weird shape there. You bounce back and forth a little bit.
Yeah.
So Under Armour's slowly on the rise.
Lulu has 4 and 5 days in
Yeah.
receivable, which is phenomenal for an athletic wear company.
Yeah, and so sorry to cut you off, but so usually if you're in this 20 to 40 days, which you can see Nike is perfectly right in the middle, that's considered the good spot. You're a healthy group. If you're above 40, you know how Under Armour is throughout the whole situation. They're on the rise, so could raise some red flags about their company. Lululemon, on the other hand, they're well below 20. They're even below 10 these past 4 years, and that is a really, really favorable thing for your guys' company.
It's kind of odd that they variety so much. We're kind of all over the place, not similar at all.
I do think one reason though they are one of the new dogs compared to Under Armour and Nike, so that could
get
be
higher up in the future.
Yes, that could be a
and you could also see this. This one shows how Lululemon being a newer brand, people are more excited about it. They're buying out the shelves. And for example, Under Armour, one that's a little older, one that's losing traction in the market.
And they may not come up with new ideas like Nike still does today.
Yeah.
As well as promotion. Nike obviously advertises more than Under Armour, which could cause Under Armour to go up as well. Okay, so now we'll switch to a different ratio, the debt management ratio. So this ratio pretty much shows how a company relies on debt and how well it can handle it, which is big for every company in the world, just not sports or athletic wear companies. So we'll start with total debt ratio.
I'll start.
Okay.
Nike consistently uses a total debt ratio of 60 to 62%. This pretty much means they use a lot of borrowed money, and this is extremely common with older companies. So Under Armour and Nike are obviously at the top. With Lulu being a younger company, they probably aren't using as much as the older brands yet.
Yeah. And then, so another thing just about this, so usually if you're above about that 60%, that means you are taking on some risk a little bit. So I think one reason, you guys can say your opinions as well, I think Nike is one of the, once again, the biggest sports athletic wear company.
Yeah.
I think they have the ability to take on a good amount of risk that won't hurt their company.
100%. Nike is over.
Yeah.
It's in over 190 countries.
Yeah,
worldwide.
they can risk a lot more than pretty much
absolutely
any other company.
You can see Under Armour slowly starting to lose that risk. They're trying to be more of a passive. Lulu probably hasn't been there enough, but the way the trending is going, they could also be up there.
More
with Nike.
sponsorships, more putting it out there. I think they will probably be higher because they'll have a lot less risk there. But
So now I want to cover times interest earned ratio. My computer just crashed. You got the bars?
Yeah.
Mine just crashed. Okay, so this was a little tricky because for some of us we didn't have anything on the interest expense. Others had negative numbers or very small numbers. So this was a little harder than usual. So for example, Lulu is a very new company. They don't have to operate under any expense. So their interest expense was 0, meaning that their times interest earned was nothing.
Yeah.
Yeah.
You want to go ahead and do
Yeah, I can
your
do Under Armour. So Under Armour was the one that was very weird here. They had 3 years in the negative, and then they also had one that was at 857, which doesn't sound right. I mean, you probably think the same thing, but it's tricky because some earnings before interest of taxes or EBIT, as we know it, values are negative, creating unusual high or negative values. This likely means that the company's ability to cover interest is very inconsistent, and we can see that with the numbers we got here. We have like -30, -20, -9, and then 857. So obviously there's not a lot of consistency going throughout this company because of the spikes that we are seeing throughout these years. Here, if you want to look at Nike.
No, I got mine. Yeah,
Okay.
I mean, mine's a lot like Lulu.
Yeah.
I mean, the time interest earned doesn't really mean much because they earn more interest than they actually pay. So there's not real importance there.
Different ratio now, huh? Different set of ratios.
Yep. So we'll go to the third ratio, fourth and last ratio here. Sorry, which is the
Well,
profitability
the fourth
ratio.
set of ratios, because
Fourth
we're still
set,
missing
yes.
4 more.
Yep.
Yeah. So the profitability ratios. So they show how efficiently a company turns sales and profits into assets. So we're going to jump into 4 different types of profitability ratios here: gross profit, net profit margin, ROA, and ROE.
These
So-
are my favorite, actually. out of
Yeah,
all.
I mean, you want to see how your company makes a lot.
So yeah, I'll start off with the gross profit margin of Lulu. So Lulu is high 50s, lowest was 55%, highest 59%. As you can see, very steady. We're at the top of the chart.
And I think another reason because that is you guys being newer.
Oh, 100%.
Yeah,
I mean, I think that factors in a lot. And I
100%.
mean,
Oh, yeah.
we're just honestly, we have a lot of traction in the athletic wear company. I
Yes.
think Lulu's up there with Aloe, Skims, and the new brands and up and coming that are gaining a lot of traction.
Yeah, and so I mean, I can speak for me and Dean here for Under Armour and Nike. We are very similar. I mean,
Very similar, actually.
I mean,
Wow.
we are. I mean, we don't really jump around a lot, I mean, we do have a little dip, but I don't think that's enough to really hurt us. I mean, it's not like a groundbreaking difference, but we are very, very
Nothing to fear
nothing,
over.
nothing to fear over here.
Yeah, I found this quite shocking. This is the first graph. Nike's on the bottom through it all, but I mean that
Yes.
doesn't mean above 40% is still obviously very good for an
Yes.
apparel brand. So it's obviously nothing to threat over, but yeah, I still found it quite shocking.
So yeah, if you want to jump to the next one here, I think this one's really interesting here for Under Armour, as we can see.
Wow.
Look at that graph.
So then this is net profit margin, and so I'll just let you guys go at first because I want to talk about my.
Okay,
mine,
so I'll start with Lulu. Lulu, as you can see, once again at the top of that chart, the lowest it recorded was in 2023 with 10%, and usually these companies, I believe, anywhere from 10 to 18% is usually very good.
Yes.
So Lulu, as you can see, is doing
I was
very
saying,
good.
Did you want to say anything about Nike? I mean, we
I
do see a
mean-
little bit of a downfall towards the end.
Yeah, I mean that
But-
usually means just higher cost or like
Yeah.
a slightly less demand. But I mean our strongest years in 2022 and 2024 were
Yeah.
still pretty good. But the drop, I don't think is anything
Yeah, I
to
would
fear
say
over.
I
think
can
it's
maybe
just
add
higher
on to that.
cost.
So you can see mine. We go to the negative, and so one of the biggest reasons why we are negative is once again, like Dean just said about price and all that. But another huge thing is competitive, and all the amount of stress and pressure these companies are putting on them. Just like Lululemon, they're the newest one, so they're going to get more attention, and it's going to cause more stress on these older businesses such as
Yeah, I don't-
Nike and Under Armour.
I don't
I do want
think-
to
I
point
don't-
out one thing. I'm sorry to interrupt
Yeah,
you.
well,
I mean, these charts honestly reflect
That's what I
how
was gonna
Under
say.
how Under Armour
Yeah.
has been trying to keep up with all these new up and coming brands. I mean, Nike's not an up and coming brand, but it dominates it. So
yeah.
I don't know if Dean wants to add anything to
I mean,
that.
It's almost
you
like
see in
they're-
2023,
Yeah.
you see Lulu and Nike go down, but Under Armour went up.
Yeah.
And then in 2024, you see Lulu go up, and both Under Armour and Nike go down. So
Yeah.
that's not a coincidence.
Oh yeah, that's way to point that out. I didn't. Wow.
Yeah. So I guess if we want to switch to the ROA
Yeah,
of
let's
our
do that.
companies now, if you, I can start.
Yeah, go ahead.
So we peaked at 2023 with a 7.71%. Once again, you can see we jumped right back down to the negative. So this is becoming a common occurrence. It seems like towards the end when we talk about the profitability ratios. how it turns the sales into profits. So something must be going wrong here because they were just going negative, you know. And
Yeah.
obviously, once again, Lulu at the top. They're doing things great. You know,
Yeah.
they're finding ways to generate those sales and turn them into a lot of profit.
Yeah, I mean the graph speaks for itself. I don't think I have to cover much on this besides the fact
Yeah,
it's
I mean,
from 15%. The lowest year was around 15.25%, which was 2023, and the rest years were just above.
I mean, your
19%.
lowest year is higher than
Your
Nike's
lowest
best
year.
year.
Yeah,
So,
exactly,
I mean,
yeah.
I mean, our highest year was at 15%, and we had like an 8% decline, which is obviously not great, but it's still very healthy. But I mean, you can see Lulu starting to dominate.
yeah. So I do. Yeah. So going to the next one, jumping ahead here. So I just want to
Last one actually.
Yeah, last one of the second episode here of the Financial Fit. So we are going on return of equity. So about this, obviously, once again, Under Armour in the negative. This one's interesting because I think, for instance, you guys are high, so about the 15 to 25% range is good. But if anything, if you're over the 25% mark, you could be almost, killing or not killing the company, but you could be, you're doing it great. You're doing a really great job. Once again, Under Armour just not performing. Once again, it's common occurrence we're seeing now. The more research we do, the more these videos go on. Just the more you can see how Lululemon is at the top.
Yeah.
Nike is starting to get pretty competitive with Lulu, and Under Armour is just a tier below them almost.
I'll jump in here real quick. Our ROE numbers range from 36 to 40 until the last year of 2024, which had a 16% decline, which is not great. And again, you can see Lulu performed and went up a lot when that happened. So it's very obvious that it's competitiveness that is, I think, driving.
Yeah, and you guys being over 25% again means you guys are very, very efficient. At using your getting your sales and turning it into new profits. Like Nike promotes more new things. Lulu, I'm not very familiar with it, but the more I'm learning, the more they promote and they're making new
The
things.
thing with Lulu is you're huge on social media and they know how to
They
use the
brand.
market to their branding.
Being a newer
Yeah.
company with probably newer workers, you
Yeah,
know how to promote it.
exactly.
And we can see how they jump up and they're being very efficient with the equity they're getting.
And
You guys
that
have any
concludes it.
last?
No
thoughts here?
last thoughts.
No last thoughts. I
ideas.
believe we covered everything. Well, that was the second episode of the Financial Fit with the
Triple D's. Don't forget to like, subscribe, and leave
Stay
a comment
tuned
on the
for
video.
episode 3.
Episode 3 coming.